Hi there, Quinn Myers here with Quinn Myers team in Remax Coastal Properties, bringing you an instructional video today on our investor spreadsheet, how it is used and how you can use it to compare properties and look at a potential purchase, find out if it's going to work from an investment standpoint, if the numbers are going to pencil out for you. I hope you enjoy. Feel free to call us or email us if you have any questions. We're here to help. Thanks so much. So here we go. Your screen should look something like this when you open up the template. When you open it, depending on when you've saved it or the template that you've seen, these numbers may be a little bit different. What you need to focus on are initially the blue boxes. So there's blue boxes just about all over, mainly on the right side and the bottom right. First thing you can put in here is your purchase price. So if you're looking to buy a property for $500,000, you can plug that in here. You can also change the interest rate. We normally keep it at about 4.5% recently, but if that does change or your rate is lower or higher, you can plug that in there. And also the number of years that you're looking to do financing. If you're paying cash, then you can disregard that box. Then you're going to move up here to the expenses associated with the property. If you're going to be managing the property yourself, obviously you can put 0% for property management. There's over here, there's a few guides that we like to use. If you're doing full-time property management, that number is going to be somewhere around 10%. If you're doing vacation, if you have a vacation rental, the property manager is going to charge you somewhere around 18. That's also can change depending on what type of a property you have and if you're doing short-term or long. So not to make this too long, property tax, we estimate right at 1.15% per year. Insurance, that's calculated based on the purchase price. That's 0.2% per year. Just a metric that we use that's pretty close. Obviously, you can change these numbers if you'd like. These two are in white because they are actually calculated, so you don't need to change those. And then going down, you've got 5% of income goes to maintenance. That's a good rule of thumb. You can put that at 0 if you'd like. And then if you're in a community where you have HOAs, you can plug in your HOA per month payment here. The last section of blues is this rents section where you can plug in exactly your rents per month. If you're doing just monthly long term, obviously you're going to go 12 months and you're going to go your monthly rental income. Now if you're doing multiple units, this is the total for the property. So the total income for a given month, and this is gross income that you'd get with all the units rented. And if you've got garages, if you're separately renting those spaces, you can put that in as well. So that goes there. If you have a vacation rental, this is the section up here to do weeks per year in the high season. So your price, your weeks per year, and then your price per week here for the low season, and then the weeks per year. If you do a mix, you're welcome to blend. You can put 4 months at monthly rentals at this rate. High season, this is a bit of forecasting too. Whether you know this about the property or not is what you'd expect for future years or what the previous owner or you as the owner has seen in the past. So just to make the point, let's put this in here and let's put this at 2,500. And let's bring this purchase price down to 450,000. Okay, that's looking a little closer. The other thing you can change if you'd like, for vacation rentals, we recommend using a rule of thumb of 10% as a vacancy rate. This is the percentage of time within a given year that the property is vacant. No matter the property you have, you're always going to have vacancy. You can use your rule of thumb here or ours. For full-time properties, we recommend putting in 5%. And that's the last thing that you need to input. So here, this number here would be your gross potential income. So this is before vacancies and before costs. This is what in a given year the property will take in. This is also how this GRM number up here is calculated. This would be the purchase price divided by the gross potential income, and that's where you get your GRM. You want that number to be as low as possible. There's some good rule of thumbs we can share with you for the different areas. And then subtracting the vacancy rate, this is your gross operating income for a given year. And then subtracting your annual expenses from up here, you get your net operating income, and this is how your cap rate is calculated. So it is net operating income divided by your purchase price. and that's going to give you your cap rate. From there, if you subtract out your debt service from your mortgage information that you plugged in down here, this would be what your monthly debt service would be. And then it's your before tax annual cash flow, subtracting out your monthly debt service at your different levels of 25% down payment, 35 and 50. That's what you have here. And then another metric you can use, your cash on cash, would be if you put 25% down, this is how much cash you'd be taking in. Obviously none if it's, as you see here, your before tax annual cash flow is negative at 25% down, so you've got none, 0.2%, and 2% from there. This is just kind of a baseline to help you. Really, you can, if you're looking at purchasing a property, you can plug in the particulars and then alter this purchase price to get you to the criteria up here that you're looking for. There's a bunch of different ways you can use it, but all you really need to know is you plug in the blues and the yellows are your output numbers to help you. We're here to help. Feel free to call us anytime if you have any questions with this, and this is just a good start for our investors that are looking for a tool to help them evaluate properties. Thanks so much.